Hey traders, how's it going? Nick from Vant Trading here, coming at you with another short and informative trading technical analysis indicator lesson plan. Now today's video, as always, is just going to be more informational, talking about what is this technical indicator, how do you use it, maybe some general trading tips on it, giving you a sense of, is this a technical indicator I may be interested in. Today's video is going to be an interesting one. It is on Bollinger Bands. What is a Bollinger Band? Why do so many people like to watch them, especially on a longer term swing trading perspective, and what are some methods that you could incorporate it into your trading? Reminder, as always, if you like this video, please be sure to drop a like and subscribe to our YouTube for future video updates, and drop a comment in the section below if you have any questions, comments, or concerns. Now, what is a Bollinger Band? How does it work? Why is it so mathematically relevant for many? Well, first of all, you're not going to be able to know what a Bollinger Band is if you don't really get a full grasp on what standard deviation is. Because basically, at its core, a Bollinger Band generally is first of all, there are three lines. As you can see, I have it pulled up on my Thinkorswim chart here. The middle line is going to be typically a 20-day simple moving average. Yes, you can change it to whatever you want. Generally, you could change the amount of days, maybe to an EMA, whatever. Depends on your trading platform. The other two lines are going to be some form of standard deviation away from that simple moving average. Typically, it's two standard deviations, both up and down from the simple moving average. What is a standard deviation? That is a whole mathematical term that, I'm not going to get too out in the weeds on here, but, if you want to do a little more research on your own, you can. What I will show you is the Standard Deviation Bell Curve. And basically what it means is that within a certain... There we go. Sorry about that. I don't know where it went. Within a certain amount of data points, say you have 1 million data points in numbers, what is the certain amount that you deviate from the average on either direction? So if you take a million different numbers and say the average is 500,000, let's just make it easy. At what point on either side can you set a marker and that equals 68% of the occurrences of the numbers? So 68% of the time, if you pick a number, it should occur within one standard deviation of that average. Two standard deviations is going to be 95% of the time, and three standard deviations is 99.7% of the time. So basically, if it's a whole mathematical formula. I'll put the Bollinger Band formula on the screen now just so you can see it. Pause it if you want to try to look at it and work through it. It's a lot. Now, basically what I'm saying is that it's a measure of statistical significance. How far away are we getting from the average, and is it significant compared to how often, or the average of how far we travel away from that average? So if it's within one standard deviation, apologize about that. I got a phone call. So basically, what I'm saying is that if you're within one standard deviation, you're moderately significant. 68% of the time you're traveling within this range. But however, if you're starting to get past the two standard deviation range, that's where you're starting to get to those extreme levels, because 95% of the time you are not leaving this range that you're now breaching. Basically, this was developed and copyrighted by a famous technical trader named John Bollinger. Wonder where he got the name from. And he used this specifically to identify overbought and oversold. As you can imagine, what he did was he looked for, are we getting too far away from the average, and are we overbought or oversold compared to the norm? So what happens is if the stock, if the stock or the ETF or whatever starts to breach that two standard deviations, that means that we're now starting to approach the extremes, or this should only be happening 5% of the time. So that's kind of how you try to measure it. Is this stock overbought? Is it oversold? Now, does that mean you should be buying or selling or exiting your position or whatever? I'm not going to get into that. That really depends, but I'll show you a couple examples of how you could have used it on the daily to measure even in the market. The market is a good example of one that kind of tries to stay within the norm. The purple and the red line up here, are two standard deviations away from the 20-day simple moving average in the middle here. Look how infrequently we're able to stay out of this range. Yes, we breach the range because, look, it's not that it never breaches this range. It only does it 5% of the time. time, and it hardly ever stays there. So you can see that we're very rarely staying out of this bubble, even when we're trending up, trending down, moving sideways, whatever. It's only in extreme moments. So this is a good example of, yeah, it kind of becomes a little bit of a buffer. And if you were a mean reversion trader or a fade trader, maybe you can try to formulate some kind of strategy on trading it back to that moving average after we breach the bubble. Something like that. That's what a lot of traders tend to try to gravitate towards. But a lot of people try to look at that. Let's look at another one, AMD. AMD, a lot of times doesn't really hold through this. It tests it a lot. And look, this is AMD is also a great example of why you can't just blindly sell if something breaches. We breached the 2 standard deviation here, and we kept going. So yes, when a stock breaks out and when there's a catalyst for this stock to break out and people are buying it, it's going to keep going because look, the moving average is moving with the stock. So that Bollinger Band is going to continue to spread and continue to move up with the stock. So, this isn't a static number. You also need to realize that this is a past-looking and backward-looking mechanism. This is not really a forward-looking technical analysis indicator. So you can't use it to really predict price action. You're really just using it to get a scope of where are we in relation to the norm. So you definitely can't just blindly buy and sell based off of it. What are a couple other examples? Let's look at Walmart, because Walmart has some moments where news catalysts, we break through and we kept going a little bit, but we also kind of ride the lightning a little bit on this sometimes. We respect it a lot, a statistically significant amount, and so that's what it works. What are some other examples? Tesla, Tesla, yes, breached it and kind of rode the lightning for a while, so you couldn't have just blindly sold and shorted against the 2 standard deviation up or whatever. So there are methods of using this as information gathering tools and maybe trying to gauge, all right, maybe is it time to start selling? Did we go up too far too fast? Or maybe now it's time to start looking for some trailing stops, something like that. Another way that a lot of traders like to use it is looking for when the Bollinger Bands start to tighten and squeeze together, because that's generally showing a moment of low volatility within the stock. And then as soon as that stock breaks out and that Bollinger Band widens, now suddenly we're moving, and you might be able to expect this stock to move a little more. I mean, heck, look at Tesla. We got really tight in here, and we finally broke out. Bollinger Band starting to widen, and you were able to get a pretty significant move. Another example, Home Depot. Home Depot got really, really, really tight in here, bounced back and forth between this Bollinger Band for quite a while, and then we actually broke out. The Bollinger Bands widened, and when we reversed, we reversed. So another good example of just using kind of that tightening and widening of the band to kind of gauge what kind of market you're in. Are you in a low volatility or high volatility market? That's another way you can do this. Now, if I were to go in here, say, and make it a 3 standard deviation Bollinger Band, what would this look like? We hardly ever breach it. That's because if you remember the chart here, 99.7% of the time we should be within 3 standard deviations of the average. If I pull up the SPY, let's see, I don't think we ever we breached it once here. We breached it once on here, so the more statistically significant you get it, again, it's not a blind reason to short. Walmart breached the 3 here and kept going. It had a news catalyst, it kept going, people kept buying it. So remember, this is not some hard set rule, but based on what you're doing, it could help give you some insight on the size of the move compared to the norm. You could try to use this on the intraday, having it on the 5-minute, trying to gauge if on the 5-minute we're moving a lot or something. I don't know many traders that do use it on the intraday and try to use it for day trading. It's generally used more for swing trading and investing and things like that, generally because it's kind of past looking. You need to wait for that bar to close before it can start changing the standard deviation, the moving average. It's not a quick reactive thing. Some people try to use them on their algos and their black boxes. It depends on you and as the trader. So that's generally what the Bollinger Band is. And like I said, you can go in here and change it. You can change it. Am I basing it off of the close, off of VWAP? There's so many things that you can change and manipulate in here with yourself. You can displace it. You can change the length of it, the amount of deviations. And you just need to make sure that you fully grasp what that number number means and what these mean if you're going to use it, because it's not just some hard set rule, it's more of an insight and a comparison. So I hope that this was helpful and informative. This went a little longer than others, but we got into a little bit of more of a mathematical technical analysis indicator here. It's a very interesting one. It's one that I used to use pretty heavily. I don't as much anymore, but I do know many traders love to look at it because many traders are math focused, and many traders like numbers and statistics, and that's, at the end of the day, that's all trading is. So hopefully this was helpful and informative. I will see you next time, and as always, safe trading.